What happens when the financial system finally runs out of road? We've seen governments spend trillions of dollars they don't have. We've watched central banks print money on a scale once considered unthinkable. But these tools have their limits. Your retirement, your savings, and your cost of living are all balanced on this reality. And we're now living in a world defined by those limits, an economy drowning in debt, where every traditional lever has been pulled, twisted, and is now close to breaking. This isn't a distant problem. This is about the value of your money. There's a predictable sequence to how this unfolds. First, liquidity starts to dry up. Then, the bond markets, the very foundation of our financial world, begin to crack under the strain. After all the bailouts have been tried and the markets are still teetering, governments have one last desperate move. It's a tool as old as money itself, operating silently in the background. This is the story of that final release valve: currency devaluation. It's the hidden mechanism that becomes the only way out, and it tells you more about the true health of our economy than any official inflation number ever could. To understand where we're going, you must first understand the ground beneath our feet. Modern economies are built on a bedrock of government bonds. It's the market that everything else, stocks, real estate, corporate debt, is measured against. It's supposed to be the safest asset in the world. But what happens when that bedrock starts to fracture? We're in an era of unprecedented debt. In the United States, federal debt held by the public is projected to hit 101% of GDP in 2026 and keep climbing to 120% by 2036. The annual deficit is forecast to be around $1.9 trillion in 2026 alone. To finance this, governments must constantly issue new bonds. But to convince people to buy this mountain of new debt, especially with inflation as a concern, they have to offer higher interest rates. And this is where the trap is set. It's a doom loop. Higher interest payments mean larger deficits, which require issuing even more debt. Net interest payments on U.S. debt are on track to blow past $1 trillion in fiscal year 2026 and a staggering $2.1 trillion by 2036. This is the fastest growing part of all federal spending. Eventually, you reach a point where the cost of interest itself begins to drive monetary policy. This dangerous state is known as fiscal dominance. It's the moment a central bank loses its independence. It can no longer raise interest rates to fight inflation because doing so would risk bankrupting its own government. The debt payments would simply become too high. As soon as investors sense this point is approaching, they start to worry. They doubt the government's ability to pay them back with money that holds its value. They start selling bonds. We saw a terrifying preview of this in the UK in the fall of 2022. The new government under Prime Minister Liz Truss announced a plan for massive, unfunded tax cuts. For a market already on edge about inflation and government borrowing, this was the final straw. Investors dumped UK government bonds, called gilts. In days, the 30-year gilt yield spiked. This wasn't just a number on a screen, it triggered a crisis. UK pension funds, which used complex strategies built on these gilts, suddenly faced catastrophic losses and demands for cash they didn't have. They were forced to sell more gilts to raise money, pushing yields even higher in a self-reinforcing death spiral. Simultaneously, the British pound plummeted against the dollar. The crisis became so severe that the Bank of England had to launch an emergency bond buying program just to prevent a full-scale financial meltdown. The UK Gilt Crisis was a warning shot for the entire developed world. It showed how fast the bond market can turn on you and how fiscal carelessness can spiral into a crisis where both your bonds and your currency are attacked simultaneously. It showed us what happens when the bedrock cracks. And this is where the story truly shifts. When a government is trapped by its own debt, it can't raise taxes enough, can't cut spending enough, and can't allow interest rates to rise to their natural level, it's left with one final insidious option. This isn't an accident. It's a strategic choice. If you can't pay your debts honestly, you pay them back with money that is worth less. This is the path of least resistance, a politically convenient default. This is the final release valve. For many, devaluation conjures images of chaos in developing nations, with people rushing to trade worthless paper for anything real. While that can happen in advanced economies, the process is usually far more subtle. It's not a sudden explosion, it's a slow, controlled demolition of the currency's value. It works just like a pressure valve on a boiler. All the pressure from unsustainable debt must be released. If you try to contain it by holding interest rates artificially low, the pressure just builds until the bond market itself starts to fail. The currency is the escape hatch that lets that pressure vent. And this is where policy becomes structural. The textbook case for this managed decline is Japan. For decades, Japan has been a real-world laboratory for extreme economic policy. Its debt to GDP ratio is over 230%, a level that would have sparked a crisis almost anywhere else. So why hasn't Japan's bond market imploded? For years, the Bank of Japan aggressively suppressed interest rates using a policy called yield curve control. They essentially printed as much yen as needed to keep borrowing costs near zero. But there is no free lunch. The consequence of that policy was a stunning collapse in the value of the yen. Between 2012 and early 2024, the exchange rate went from approximately 80 yen to the US dollar to nearly 160. That is a massive depreciation. This wasn't a bug, it was a feature. By allowing the yen to weaken, Japan exported its economic problems. A weak yen made its exports, like cars and electronics, much cheaper for the rest of the world, propping up its economy. At the same time, it slowly chipped away at the real value of its enormous pile of domestic debt. The pressure didn't explode in the bond market, it was safely vented through the currency. Even now, as the Bank of Japan faces pressure to change course, it remains in the same trap. Raising rates too much could make its government's debt completely unsustainable. This is the core of the strategy. It avoids the sharp, immediate pain of a government default or crippling austerity and swaps it for the chronic, slow burn pain of a currency that's losing its value on the world stage. We're exploring how these massive global forces are changing everything we thought we knew about money. If you're getting value from this and want to keep connecting the dots, take a second to subscribe. We break down these complex issues every week to help you see the bigger picture. You might be thinking, isn't a devaluing currency just a fancy way of saying inflation? It's a fair question and a common point of confusion, often because the financial media uses them interchangeably. But the difference is absolutely critical. The inflation number you see in headlines, the CPI, measures how the prices of things inside your country are changing. It's a measure of your domestic purchasing power. A falling currency certainly contributes to that by making imports more expensive, but it's a fundamentally different force. Devaluation is about your currency's value relative to other currencies and global assets. It's a measure of your international purchasing power. Here's a metaphor. Domestic inflation is like the tide going out in your local harbor. The water level drops for everyone there. Devaluation is your entire harbor being physically lifted up, changing its sea level relative to all other harbors in the world. Suddenly, every boat in your harbor is higher, but it can't buy as much from any other harbor. Your entire local economy has been repriced on the global stage. This is how an economy can push its problems onto the rest of the world. By devaluing, a country makes its goods and labor cheaper for everyone else, but it also makes its own citizens poorer in global terms. The pain isn't felt just as a price shock at the grocery store, but as a gradual erosion of your wealth and your country's economic power. We saw this dynamic play out in the United States during the 1970s. That decade is famous for runaway domestic inflation, stagflation. But it was also a time of major dollar weakness. After the U.S. severed the dollar's link to gold in 1971, ending the Bretton Woods system, the dollar fell significantly against other major currencies like the German Deutschmark and the Japanese yen. This devaluation was a necessary adjustment. It helped correct a large U.S. trade deficit and absorb some of the economic pain. But for everyday Americans holding dollars, it was a double whammy. Not only were prices rising at home, but the value of their money was falling abroad. Their ability to buy foreign goods, travel, or invest overseas was shrinking. The key takeaway is this: a government can play games with its domestic inflation numbers, but it cannot hide from the verdict of the foreign exchange market. A currency's exchange rate is a relentless, unforgiving report card on a nation's policies. When it begins a long-term structural decline, it is screaming that there is a deep problem that can't be papered over. This is not theory anymore. When investors and even regular citizens realize a currency is in a long-term decline, they don't just sit there and watch their wealth disappear. They act. Capital has no loyalty. It flows away from weakness and towards things that are strong and safe. This sets off a massive global reshuffling of wealth. This isn't always a panicked rush for the exits. Often, it's a calm, rational rotation. If the money in your bank account is designed to lose its global purchasing power, you will naturally look to trade it for something that won't. So, where does it go? This entire rotation is driven by the same stress we saw in the bond market. As trust in a government's debt erodes, capital begins its search for an exit. Historically, the first stop is stronger currencies. Capital simply leaves the weakening currency behind and moves into those seen as being managed more responsibly. The second and perhaps most timeless destination is hard assets. This is where the story of currency devaluation and the story of gold collide. Gold is the ultimate monetary asset that doesn't rely on anyone's promise to be valuable. It cannot be devalued by a central banker's keyboard. It's no coincidence that during the dollar's weak period in the 1970s, the price of gold skyrocketed, shooting up from $35 an ounce to a peak of over $800 in 1980. Gold was simply repricing itself against a failing dollar, acting as a financial lifeboat. From there, capital flows into other real things that can preserve wealth. This includes other essential commodities like oil and copper. It also includes productive real estate in stable countries, assets that don't just hold their value, but can also produce an income. The common theme is a flight from paper promises to real things. When a government signals through its policies that it intends to devalue its currency to solve its debt problem, it is openly telling you that holding its cash and its bonds is a losing game in global terms. Smart money listens. It finds shelter in assets that have real intrinsic value, are scarce, and cannot be printed into existence. This rotation isn't just for billionaires. Anyone who diversifies their savings into global stocks, owns real estate, or holds a portion of their wealth in precious metals is already participating. They are making a choice to step outside of a single, weakening monetary system to protect their purchasing power on a global stage. This flow of capital is the market's ultimate vote of no confidence and the final verdict on a country's economic management. The path we've traced is a logical, almost inevitable sequence. It starts with governments making promises they can't afford, leading to mountains of debt. To manage that debt, central banks are forced into a corner, suppressing interest rates and printing money until their old tools become useless. The pressure builds relentlessly until the very foundation of the system, the bond market, starts to give way. And at that moment, the final release valve opens. Currency devaluation becomes the only option left on the table. For most advanced economies, this isn't a story of a sudden, dramatic collapse. It is a story of a slow, managed decline. It's the quiet, politically convenient way to default on your promises. Not by refusing to pay, but by paying back with money that is worth less and less every year. This process is a hidden transfer of wealth. It punishes savers and anyone on a fixed income. It erodes a nation's standing in the world and the financial power of its citizens. Watching the long-term trend of your currency is no longer just for economists. It is one of the most critical signals about the true health of the economy and the safety of your financial future. The slow bleed of a currency's value isn't just market noise. It's the clearest signal we have that the system is under extreme stress and that the final lever has already been pulled, and it does not move in reverse. Thanks for watching. If you want to keep exploring the powerful forces reshaping our financial world, make sure you're subscribed with notifications on. What are your thoughts on where we are in this cycle? Let me know down in the comments. See you next time.